Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio. Every month we meet with the Akron Investment Group, and who could not attend to our meeting asked me to set up a video so that they could see what we're talking about. The last session was very, very interesting, very exciting. So here it is, what is all about. Our sessions are a free format. Everybody can say anything they want. There's a big discussions. We agree, disagree, and we agree to disagree. So before the meeting, I sort of set up a guideline of the subjects that are most relevant for that particular period. So for this meeting on 10:15, I thought that we should talk about the macro picture, the issue about rising inflation and interest rates, and what the role of Milton Friedman research, and what are the reason for the strength of the dollar, why all assets are declining. Bitcoin, I don't know if you read my article, but this is an interesting subject. We are in a recession, would be a recession just by looking at M2, the money supply M2. When will the bear market end? And there are several indicators that can suggest that when it will end. Yield curve and interest rates and inflation are some of them. Then we are going to talk about what are the strongest sectors since the beginning of the year, since September, when the bear market started, and what is the best investment strategy for this particular time. So this is what the conversation went about. Since I suggested to review the macro picture, the dollar and what happens around the world, I thought it would be appropriate to show the business cycles as published by the OECD, the Organization of Economic Cooperation and Development in Paris. And the nice things about this chart, this is for the total developed world, the business cycle. These are all the tops, and these are the bottoms. So I put what the Euro business cycle looks like. This is the business cycle in China and business cycle in the United States. I guess the point I wanted to make to the group is, look, before we start talking international stuff, we better realize that the business cycle are completely coordinated around the world. So they are synchronized, perfectly synchronized, no matter what their culture, language, whatever system, all the business cycle is synchronized. Why? Because of the trade, the pervasiveness of the trade around the world. So keep that in mind. The synchronization of the business cycle is also reflected in the synchronized behavior of all the markets of the developed countries. As you can see, you just checked with the previous slides. These are the tops and bottoms of the business cycles. This is for the European business cycle. This is the Chinese, as you can see, still the bottom and top. This is the even emerging countries. This business cycles is reflected by fast down, up, down, up, down. And even, of course, for the United States, this is a special indicators we developed. And as you can see, they match exactly the turning points of the business cycle of the previous slides. And of course, this is the strong market, weak market, strong market, weak market, strong market, weak market, strong market, and weak market. Of course, all this also reflected in investment strategy, depending if the economy is strengthening or weakening. But we'll talk about that later. We had a big, major discussions of probably an hour and a half on this chart. It's fascinating what all the viewpoints. But the bottom line is this: we have high debt, U.S. and foreign country, high, very high. So if you remember if you at least read the research by Reinert and Rogoff, or the book by Rogoff, this time is different. High debt really forces countries to grow very slowly. So this slow growth, and we saw that all the business cycle in U.S. and overseas are slowing down. The problem is that the foreign economies slow down, capital flows into the US because it's the most liquid financial markets. So, and this is what is strengthening the dollar. By the way, this is another thing where people said why the dollar is strong. Well, it's not interest rates, believe me. First of all, the classic example is what happened in the 70s. In the 70s, the United States had very high interest rates, up to 20%, inflation of 15%. The dollar was very weak, and the Germans and the Japanese, with their cars and their imports, just ate our lunch. So the high interest rates actually, another example would be Brazil. Brazil, with the interest rates at the levels they have, would have the strongest currency, instead is one of the weakest. So interest rates, and then there is also research showing, this would be the subject of another video where I will show that interest rates are 50% correlated with the dollar. In other words, 50% of the time they go together, otherwise they don't. So there is no relationship whatsoever. There is a relationship, but for very short-term hedging, say a year or so. But otherwise, over the long term, currencies are a function of, and I had developed models when I used to work in this area, they are related to productivity differentials between two countries, or also between inflation differentials between two countries. That's the only really determinant of currencies. Anyway, having said that, now foreign countries, as you saw, they're very weak. So what they do, they sell local currency to buy dollars because they want to find refuge in US. So what they do, they buy stock and other assets in US dollars. However, by selling the current local currency, now their currency weakens. The currency weakens relative to the dollar. Now, the problem with a strong dollar and a weak currency, the countries with a weak currency, now they have to pay the interest on their debt, which is mostly denominated in dollars within the euro-dollar system. They have the difficulty to pay interest because of their weaker currency. So in other words, it costs more to pay the interest to a dollar loan. So what do? They have to raise cash. How do they raise cash? They sell treasury stocks, any assets whatsoever they have to raise cash to protect their local currency. So they sell treasuries, interest rates rise. Now they're even more in trouble because now they have local weak currency that they have to sell to buy dollars to pay the loan. So it's a vicious negative cycle that is not going to end well. There's only one person who said that well ahead of everybody, and this is exactly what is happening. So how is it going to end? Well, there are the way I see it, there are two ways. Either you have rising inflation, and inflation is going to settle the debt, or, which is unlikely, because rising inflation means that interest rates are going to go much higher. And of course, with the kind of debt that we have around the world, all the countries are going to really go bankrupt. So there is another solution, is to create such a slowdown so bad to bring back interest rates to 0%. If they bring interest rates back to 0%, then the problems is partially solved, as it is partially solved in Japan. The bottom line is that the markets are being increasingly more dominated by governments and not from private investors. For instance, the Bank of England saved pensions, bonds, pension funds, and by buying bonds. The ECB, because of the mess that they created in Europe, they're buying bonds of Spain and Italy with the money supplied by Germany. The Fed is, of course, stimulus programs. We know about QE and QT. And also recently, just the Fed gave $10 billion roughly to the National Bank of Switzerland so that they could supply dollars to other banks. So they were the National Bank of Switzerland was the intermediary for selling dollars to other banks at 3.3%. So there is a global role for governments to take over the financial markets, and therefore, well, it's going to be interesting the way it's going up. I think, quite frankly, we're going to end up with deflation and 0% interest rates, because the alternative is not viable. This is a chart of the dollar, and of course has been very strong. And the strength of the dollar, as discussed in the previous slides, is really creating some trouble for countries with, of course, with everybody else as a weak currency, because now they cannot repay their interest in dollars or their loans in dollars, because it's going to cost more and more and more. So there is a point that probably there's going to be some type of accord, like in 1985, the Plaza Accord. This is the chart of the dollar, and this is an indicator that we developed at Peter Dack and Associates, and we call it the business cycle, because it reflects exactly the turning points or the business cycles that I showed you in the first slides. Now, the interesting thing that this is computed from U.S. market data. It doesn't have anything to do with the data that the OECD collects. So it's very interesting how everything is connected together. But the interesting thing about this chart, notice that when the economy strengthens, the dollar weakens. When the economy weakens, the dollar strengthens, and vice versa. So it might be a coincidence, but there is some factors that obviously creates this counter-cyclicality of the U.S. dollar. The plunge of the yen since 2021, and by the way, coincides since the Fed really has been tightening and the money supply in the U.S. has been slowing down. The plunge in the yen correspond exactly to the dive of long-term treasury, of the price of long-term treasury notes. Or for instance, TLT has been declining quite sharply. Why? Because as the Japanese saw their currency weakening, they were selling treasuries to defend the yen. The pound is also relative to the U.S. is also weak, and as you can see, matches exactly the turning points of the business cycle. In other words, when the business in the United States weakens, the pound also weakens, and this is what is happening again in this cycle. Obviously, this big dive, like for the yen, it corresponded to a big sharp rise in long-term U.S. interest rates. So it's not a coincidence that the two events happen at the same time. Clearly, all countries are selling treasuries to defend their currencies, which is the reason why long-term interest rates have been rising. The dramatic, and I'm not saying this seriously, this is a dramatic relationship between business cycle and bond yields, is that yields decline when the economy slows down, rise when the economy strengthens, decline when the economy weakens, and rise when the economy strengthens again. This time, the economy weakened, and instead the U.S. Treasury 30-year Treasury yields in the 10 years, everything went up. Why? Why this cycle is so different from 50 years of history? Again, because the euro-dollar market I think, is sending some serious signals that all banks are liquidating any type of assets, even the safe treasuries. They need cash because they have to defend their currency and their economies. So we are going through some very, very unique times. The reason I'm showing this chart for two reasons. First of all, one of our group, a good friend of mine, in the last time said when interest rates rise, all interest rates rise. This is true. However, in this particular case, interest rates were rising. This is the 2-year notes, and this is the 30-year Treasury bond yields. They were rising, but the 30-year was flat. The 30-year started rising beginning in 2022 in April, together with the 2-year note. This is the rate on 90-day T-bills, and this is the Fed fund rates that is established by the Fed. So yes, when interest rates rise, all interest rates rise sometimes, but not at the beginning of the cycle. The other thing that is interesting about this chart, notice how these interest rates started going up in 2021. And look when the Fed started eventually raising interest rates, 2022. So my point is, look, watch the 2-year notes. This is the market setting, is a rate set by the market, and there's a leading indicator of what the Fed is going to do. Right now, it's going up, and that's what the trend is. Where do we go from here as far as the economy is concerned? Well, this is the leading indicators published by the Conference Board. This is the change over 6 months. And as you can see, the leading indicator is plunging and is plunging and is at levels that have been in a recession. So the idea of a recession, as far as the market is concerned, is not that important. The important thing is the economy is going to keep slowing down, and it's going to slow down for quite a bit of time. And this is what this indicator is saying. So all the investment strategies, all the outlook, everything you're thinking of should be geared towards the economy keeping slowing down. Another reason why you ain't seen anything yet is because inventories, and I've been saying this for a long time, are still growing at double digits. And this is the inventory to sales ratio published by the Bureau of the Census. And as you can see, the inventory to sales ratio rising means that the economy is likely to slow down, because as inventory slow, growing faster than sales, business tends to reduce production to reduce the level of inventories. Right now, as you can see, inventory to sales ratio is rising, so we are still in the process of a major inventory correction, which has started, but just at the beginning. Again, inventory after inflation is still growing at double digits. Usually they go at 2, 3, 4%. So it's going to take a long time before inventories from double digits, 13, 14%, goes down to 2%. So this is going to be a long, protracted, painful process. Well, if you don't believe me, these are the data. This is the growth of inventories. And as you can see, it's still at double digits. But notice here, the economy is already growing at 0%. Because if you look at this, the personal consumption expenditures year over year is 0%. So the economy is already not growing. Doesn't matter what the government publishes, this is spending is zero. This is 70% of the GDP. And look at income. Income's been declining since January 20, the middle of October 2021. Actually, it's from here, which is July 2021. So people are making, this is of numbers after inflation, by the way. So this thing has to go down big time, and it's going to take a long period before this adjustment is made. And of course, as this adjustment is made, what it means manufacturing has to order less raw materials, has to borrow less, and this means continued decline in commodities and continued decline, eventually continued decline in declines in interest rates. Well, let's talk stocks now. This is a chart that I showed the first time, when we met months ago, and there was an inflationary time. So the question was to the group, said, okay, how do you invest your money when there is inflation? And this is the 1966, 1982 Dow Jones, which of course didn't do a freaking thing during this period. So I always tell the story that in this period is when I started my business, and I was ranked always #1. Of course, I didn't sell any subscriptions. Why? Because I was in cash. Because I realized that with interest rates going up and the market going down 30, 40% during a recession, the best way to stay is in cash. You make 10% and you go for, so I was always, if you go back to that period, in fact, in 1989, I think I was ranked #1. I was shamefully embarrassed because I was always in cash. So, but I thought that I was a great investor. I don't know. But anyway, the point to the group was, if you don't know what you're doing during inflationary time, don't try to beat the market. Just stay in cash and wait for the conditions that you need to see for the next bull market, which I will tell you later. This is the graph I have from my book, Profiting Bull or Bear Market, how the business cycle impacts all asset classes. Yeah, or asset prices actually. And is my guideline, absolutely. This shows that the business cycle goes this way. This is average growth. And this is the time where the economies start coming out of a recession or very period of slow growth. The economies start growing. This is where the excesses are created, commodities, interest rates, inflation rise. This is when business decides to cut inventories because inflation is eating up income and therefore sales. So there is a sort of beginning to see a top in commodities and interest rates. This is the corrective phase. This is the most painful phase. This is when everything comes down. This is where we are at right now. And this is what determines the depth of the recession or the slowdown. What is creating the depth is how long does it take to take down interest rates and inflation and commodities so that consumers have reestablished some type of purchasing power so that they can start buying again, production increases and so on. So this thing lasts as long as it takes for the market to take inflation down big time. And the trick is, if you want to have a long business cycle like we have in the 90s, is be keeping inflation low. Then the business cycle, this is very slow, it's not as deep, and the economy grows and it's nice growing. But if you allow here inflation, interest rates that fast, then the correcting phase here is going to be more severe. There's no question about it. This is not being saying, this is the godfathers of the business cycle when they started doing research in 1933, I guess. So keep this in mind. Another way of looking at the business cycle is through the leading, coincident, and lagging indicators. And what I said, phase four lasts as long as takes inflation to come down and interest rates. These are the lagging indicators. This is the time when they finally peak and decline, then the leading indicators start rising, which means for instance, the yield curve start flattening, stock prices rise, credit spreads decline, all the leading indicators start going up. Then after roughly 6 to 12 months, then production, income, sales start going up again. So this is the trick. If you want the bottom of the leading indicator stock market, you've got to have this coming down big time. This is a chart that shows the so when the bear market end. This is an interesting chart, scary but interesting. This is the yield on the 2-year Treasury notes, the blue line, okay? And this is the stock market. The gray areas represent recessions. Now look what happens. When is the bottom of a bear market? These are the bottom, this is the bottom. Now look now at the relationship between the top of the 2-year yields to the bottom of the bear market. The yield has to decline big time for anywhere between 6 to 12 months, if not more. It happened here. It happened here. It happened here. And guess that if the Fed is still in the process of raising interest rates, we need at least another 6 to 12 months, at least, for this curve to decline big time, before the next bull market starts. So this is a slide that always gives me pause, makes me think. This is another interesting chart, relationship between when does the next bull market start. This is the stock market. And this is the yield curve as the difference between the 10 and the 2-year. So when the 2-year is greater than the 10, of course, then the difference is negative, and people say the curve is inverted. Right now, it's big time inverted. Very rarely seen 0.552 52 basis points negative. But the interesting thing is, look what happens, what it takes for the bear market to start. Let's start here. This is the bottom of a bear market. Now go up and look where is the yield curve? It's positive and is around 1. That is 1 percentage point or 100 basis points. Now let's go to this bottom. Look at the yield curve. 200 basis point. Look at this bottom. Go here. More than 200 basis points. This is the bottom. What was the interest rates? 50 basis points. So the point is, for the bear market to end, this curve here has to go up at least around this level, probably closer to this level. How long will it take? Well, from here to here, from here to here, from this point to this point is at least a year. So we are talking possible bear market bottom until the fall of 2023, possibly. Some technical indicators, this is the stock market, and this is the percentage of stocks above the 50-day moving average, and now is down around this level, which means there is a possibility that we're going to have a rally here, a technical rally. But look, this is the 200-day moving average. I would say, yes, there's going to be a rally, but probably, given what I said in the previous 2 slides, is going to be pretty muted, or at least it's going to be short-lived. And I have the feeling that comes December, January, the stock market will probably weaken again. But stay tuned, and we'll talk about that later. In the meantime, since when the bear market started in September 2021, which groups have been the strongest? Well, only one group, and this is the energy, which is up 73%. Next is staples, -4, utilities, -8, healthcare, -8, industrials, -17. So these are the defensive that performed better than the market, which was down 21% since from the top to October 12. So, and everything else is down more than 20-30%. So again, notice that the strongest, relative strength-wise, the strongest sector being the defensive, where the energies have way outperformed. Thanks to the stupidity of the planners of the EU-LALA land. The following are some representative energy stocks that have done well. I look at this curve to show the relative strength. If it rises, this means the stock is performing better than the market. And this is BP as a rising 200-day moving average. The prices is rising. This is rising. So clearly this has been. ConocoPhillips has been a wonderful stock, much better than the BP. Look at the relative strength, outperform the market big time. This is the kind of stocks you want to have in your portfolio. What I try to do in my work, try to find this when they start turning up, or if they turn down, I sell them. If they turn up, I buy them. CVX is another great performing stocks, and again, you see the relative strength going up. So that's where you want to be. Now, if the relative strength goes down, like in this case, then you know that this is when this momentum gets started, like for other stocks, like for instance, Microsoft, or like Facebook, like Amazon. I mean, when this thing starts, the red line goes below the blue line and the relative strength declines, you've got to get rid of that stock because you know it's going to outperform. But when the relative strengths are rising, then you know that the momentum of the stock is up if people are buying. This is AOG Resources, again, another energy stock with superb relative strength rising. Notice that all the energy stocks have been weak, until the fourth quarter of 2020. But then eventually they started moving up all beginning towards the end of 2021. I'm sorry, towards the end of 2020. This is the best. This is clearly the best performing LNG, and of course this is liquid natural gas. They're the leader in the business. They're supplying Europe any way they can. So this is a superb chart, superb relative strength, superb company, no question about it. Marathon Petroleum, another great energy stock, rising relative strength. So you don't have to get very sophisticated. Just buy things that start turning up in relative strength, and they reflect the markets. In this particular case, obviously the energy market is the place to be probably for a long time. Occidental Petroleum, another stock rising in the energy sectors, rising relative strength. What do you want to say? I think this is probably, my thought is that this is a sector that is likely going to be attractive for a long time because of all the screw up that they're making in Europe and all this idea that we have to switch to green energy, and which is probably a great idea, but to go from here to there, all this sector has been underinvested. So this sector is going to be in great demand during this supposedly transition, and that's why these stocks are moving higher. Another great company, ExxonMobil, great dividend, rising prices, rising relative strength. It can't go wrong. Two more stocks with the same pattern, DVN and EQT. So these are some of the best. I think they're probably some of the most attractive large corporations in the energy space. This chart is, I use it as my Bible. This is the period that is strong economic growth, and this is strong economic growth. This is when the excesses are created, inflation, interest rates, commodities start rising. This is when the inventory correction starts, and this is the correction phase where we are now. During the period of slower growth, there is no question, as I showed you even in the chart before, the defensive sectors from here to here are the most attractive in terms of relative strength. Doesn't mean that they make money, but you don't lose as much if you have that strategy in place. Usually, in 200 years of history, bonds are also very attractive, except in this period because of the international crisis that is brewing in the euro-dollar market. But I think eventually bonds will shine. When all the interest rates, commodities, inflation will decline. We saw that inflation, short-term interest rates has to decline at least 6 to 12 months. Then you will be here, and then you will start switching to growth stocks again. And again, the energy stocks will still shining because this is when they start really commodity-sensitive stocks also start improving, and the cyclical stocks, and the cycles start lower again. So right now, we are in a wait and see, very rough water, and be careful until the yield curve steepens, the 2-year notes that's coming down for at least 6 months, and this is what any inflation declines big time. Until that time, we'll have to be defensive. Anyway, as I mentioned, I'm the editor of the Peter Dack portfolio. That you can, so you have a complimentary subscription at peterdack.com. I wrote 3 books: Profiting in Bull or Bear Market, How Business Cycle Impact the Financial Market. This was commissioned by McGraw-Hill Education, and it comes from a course that I've taught for many, many years. Then I wrote also Easy Ways to Beat the Market with ETFs and Investing Wisely. It is easier than you think. I'm very active in this, writing articles for Seeking Alpha, which, by the way, you will read them all in the subscriber area. I publish on Talk Markets, Fox Empire, Money Show, and again, you will find all my articles and other things all my forecasts, recommendations, as you can see how wrong I've been or how right I've been. Actually, my articles on Seeking Alpha have been pretty good. I know I shouldn't say this, but using the business cycle, I said more things right than wrong. And let me say with humility, I'm proud of it. Well, I want to thank you for following this update of our Akron Investment Group. And if I have good response from you, please let me know if you like it. I will post it every month after we have the group, which is usually a pretty active discussion, and we really enjoy it. Again, thank you very much. Take care. Have a wonderful month until that time. By the way, you can always saw my videos on YouTube. They're all there. Thank you. Bye bye.